In today's video, I'm going to talk about private money lenders versus hard money lenders. And is there really a difference between the two? I'm going to give you 3 similarities and 3 differences. So let's talk about it. What's up, gents and ladies? Chad Brandon here, private money broker to the stars. Who are the stars, you may ask? You, that's who. I'm also a real estate investor, and this channel is going to be all about my wonderful experiences as a private money broker and as a real estate investor. So come share in this journey with me as you experience both my successes and my failures. It's going to be a fun ride. So the first similarity between private money lending and hard money lending is that they are both asset-based loans, meaning they're dependent on the value of the property. Is there any equity, any profit in the deal? Taking, for example, fix and flip, since that's one of my exit strategies. If you have a purchase price of $100,000 and it's going to take you $50,000 to rehab it, but after it's all said and done, it's going to be worth $350,000. That is enough equity, enough profit in the deal to not only pay back the loan that you got with your interest rate, but also a nice cushion for your profit margin. The second similarity is that the real estate itself is backed by the loan, rather than the personal financial situation of the individual borrower. So that's a great thing, because you could be a person with a credit score of 500, but if you have a good deal, you'll still get funded because it's not going to be based on your personal credit score alone. It's going to be based on that real estate, the asset itself. The third similarity is that private money lending and hard money lending both form the bulk of non-traditional lending. So in other words, if you're not going to get it from a bank, or if the bank isn't going to let you get the funds, you're going to get it either from a hard money lender or a private money lender. Which brings me to a quick sidebar real quick about interest rates. You know, interest rates, a lot of people complain about them, but they really are immaterial, and here's why. It's because it's all a numbers game and it's all math. So interest rates should really not matter as long as you have everything factored in up front and baked into the deal. Okay? It's immaterial. Whether it's a 4% interest rate or a 14% interest rate, as long as you know that your ARV is out far enough to where you have that cushion as well as your profit margin, then the interest rate should not matter, and it doesn't matter. All right? So don't worry about interest rates. Do the numbers, know your math, have it all baked in up front, whether it's a low interest rate or a higher interest rate. As long as you're still being able to pay back that loan and make your profit margin, it's really immaterial, so don't sweat it. So now let's talk about the differences. And these differences have more to do with the organizational structure and the way they work, as well as advertising. So difference number 1, hard money lenders actually form organized businesses. They're going to be S Corps, C Corps, more than likely LLCs, and they're going to be licensed and bonded in some type of way. Private money lenders are just that, private individuals. They could be your friend, a family member, a neighbor, a business associate. Difference number 2, hard money lenders have a certain set of criteria that a borrower must meet in order for them to be deemed eligible for the loan. Now, this isn't to say that private money lenders will not also have a certain set of criteria, as all loans that you get are going to have rates and terms. But just that, the criteria of a hard money lender more than likely is not going to be as flexible or as lenient as a private money lender. Difference number 3. Private money lenders do not advertise. So unless you know one or some, you're not going to know who they are. But that is where I come in as your private money broker that already has access to and connections with these private money lenders to be able to get you consistently funded for your deals. Now, not advertising is actually not such a bad thing, because then you have more flexibility in your negotiations with a private money lender. So there you have it, folks. I provided you with 3 similarities and 3 differences between private money lending and hard money lending. Hey, feel free to leave me a comment down below and let me know what you think. And do me a favor, please click the subscribe button and hit that notification bell so you can be notified of all my new video releases, the next of which will be the do's and don'ts of securing funding for your real estate deals. Until then, remember, you are the power, use it for good, and be happy, my friends.